Hello, this is Bob Steele. In this lecture, we will continue on Chapter 12. We're moving on to the admission and withdrawal of partners. So we have the admission and withdrawal of partners. When the makeup of the partnership changes, the existing partnership is dissolved. A new partnership may be immediately formed. What that means is that if a partner leaves or a new partner is admitted, the partnership is thought of to have dissolved, meaning it kind of goes away and then can be reformed, meaning we have new terms in the partnership and the partnership agreement. New partner acquisition partnership interest by, so a new partner can join the partnership by either purchasing it from the partner or purchasing investment assets in the partnership. So notice if you had the partnership here and the new owner here, the new owner and then the partner who is actually selling the partnership, the new owner could put the money into the actual partnership, or the new owner could pay the partner for the partnership interest. So these are the two different types of ways that this could happen. Let's take a look at the journal entries on these two different forms of paying for a new partnership's entry. So purchase of a partnership, a new partner can purchase partnership interest directly from the existing partner. The cash goes to the partners, not the partnership. To become a partner, the new partner must be accepted by the current partners. So in this case, if you've got the partnership, the new person, and then the partner selling their partnership interest or part of their partnership interest, the money's not going into the partnership, it's going to the partner, and the partner is giving part of their partnership interest. So if we look at the journal entry on that, on January 4th, Hector Perez sells 1/2 of his partnership interest to Terrell Rashid for $18,000. Perez gives up $13,000 recorded interest. So he's selling 1/2 of his interest in the company, which amounts to $13,000 of the capital account. So notice the cash here, you might think, well, where's the cash in the journal entry? The cash is not going to the partnership, it's going to the partner. So the partner is getting the cash and the partner is giving up a piece of their partnership. So the only thing affected within the partnership then is the transfer of Perez's capital, the amount that is owed to Perez in essence, to Rashid. His capital account's going down, not by the amount of money that was received, but by the amount that was agreed upon to transfer the partnership interest, which in this case was $13,000, 1/2 of the partnership interest. So that means the journal entry to do that would be reducing Perez. Remember, capital has a credit balance, so we're going to make it go down by doing the opposite thing to it, which is, in this case, a debit. And then we're going to increase the capital account for Rashid because the Rashid's going on the books. Capital accounts have a credit balance. We're going to make it go up by doing the same thing to it, a credit. So we have this, the same total here, but just the distribution between the partners is now different. So investing assets in a partnership. The new partner can gain partnership interest by contributing assets to the partnership. Now, if we have the new partner and the partnership, now the money is going to the actual partnership. So this is going directly into the partnership rather than paying the partner, and we'll see the transaction related to this type of new entry of the partner. The new assets will increase the partnership net assets. After admission, both assets and equity will increase. So first we're going to look at the perfect scenario here where on January 4th, Rashid is admitted to the partnership with a payment of $22,000 cash. So in the easiest way to record that would be that is cash affected? In this case it is, because Rashid paid the partnership, not the individual partners. It's going to the partnership bank account, and cash has a debit balance, therefore we're going to make it go up by doing the same thing, which in this case would be another debit. And then we're going to credit something, and the easiest way to think about this is we would just credit cash, because now Rashid is now owed back that $22,000. That's what Rashid invested, and therefore that's what the company kind of owes Rashid at this time. And of course it should go up with the accumulation of income, and it would go down with the accumulation of losses and whatnot. And the capital account has a credit balance, and therefore we're going to make it go up by doing the same thing, which in this case is another credit. Notice the difference here in the total in the equity accounts was at 78, and of course it went up now because the $22,000 went into the partnership, whereas before it didn't go into the partnership, it went to the partner. So now we have a new total capital in the partnership, in this case, of 100. So now we're going to talk about the bonus to the old or new partners. So if we have a bonus to the old partners, when the current value of the partnership is greater than the recorded amounts of the equity, the old partners usually require the new partner to pay a bonus. So we're basically saying that the amount that was given from the new partner to join the partnership is different from the value of the partnership. And we're going to have to we'll have to account for that as we record the journal entry. We can also have a bonus to the partners. So the partnership may grant a bonus to a new partner if the business is in need of cash or the new partner has exceptional talents. So let's take a look at what this would look like. On January 4th, Zain and Perez agreed to accept Rashid as a partner upon his investment of $42,000 cash in the partnership. Rashid is to receive a 25% interest in the new partnership. Any bonus is attributed to the existing partners and is shared evenly. So in order to do this calculation, we're not just going to put Rashid on the books, his capital account at $42,000, the amount that's input. We're going to put him on the books at 20% interest in the company. And remember, if we take the assets minus the liabilities, it equals the partnership equity. So what we first want to do is value the partnership equity. So we're going to say it started out with the 3 partners at 78. If Rashid puts in 42, the equity goes up because the cash is going into the company. Therefore, the book value of the company is $120,000. We're going to give Rashid, for that $42,000 investment, a 25% interest. So 120,000 times 0.25 is 30,000. So that means if we take a look at the journal entry, we're going to get cash. The company's getting cash, so we're going to debit cash. Cash is going to go up. How do we make it go up? We do the same thing to it, which in this case would be another debit of the 42 that Rashid put in the partnership. But we're not just going to credit Rashid the 42. What we're going to do is only credit the 30. Why? Because that's what we agreed on. We agreed on the 25% interest in the partnership for Rashid. And you might be asking, well, why would that happen? And the idea would be that we value the partnership on its book value. There may be things that aren't included in the partnership balance sheet that we believe there's value, and Rashid believes there's value to, such as our name, such as the goodwill of the company, and the history and the client base that has been there. Therefore, the 30,000, the 42 is paying for the book value assets in the company, but there are assets over that. Therefore, the 42 is we're only given a 30% interest in the partnership for that 42,000 received. The difference is a bonus to the partners. So the partners are increasing their capital accounts evenly by the difference. So you can think of it as the 42 minus the 30. That means we need a $12,000 plug, and we're going to increase that plug to the partnership capital accounts. Remember, the capital accounts have a credit balance. We're going to make them go up by doing the same thing to it, which is another credit. So in essence, these 2 partners who were there before now have the partnership basically owes them more money. The amount owed to these partners has gone up in essence. So the bonus to the new partner could work the other way around. On January 4th, Zain and Perez agreed to accept Rashid as a partner upon his investment of $18,000 cash in the partnership. Rashid is to receive 25% interest in the partnership. So now, once again, same calculation. Before we had the $78,000 in the capital account, we have to increase that by the amount of cash that's going to go in there, which in this case is $18,000. That gives us a book value in the partnership of $96,000. We agreed to give Rashid, for the $18,000 that was put in there, a 25% interest. 96 times 25 is the 24. If we work the journal entry out, we're going to say, okay, cash is debited. I know that. That's easy because we received $18,000. It went to the partnership. Cash is a debit balance. We're going to make it go up by doing the same thing, which is another debit. And we're going to put Rashid on the books, but we're not going to put him on the books for 18. We agreed on the 24. So now we have a credit of 24 and a debit of 18. That gives us a difference, a plug that we need to put in there of 6. And we said that we were going to split that 50-50. So now notice what's happening is the capital accounts here are actually going down. So we're reducing the capital accounts have a credit balance. We're doing the opposite thing to it, which in this case would be a debit. And that means that we actually gave Rashid the bonus because we got $18,000 and are giving a book value in the company of $24,000. And that could be that maybe Rashid's coming in with a big name, or maybe if it's a law firm and Rashida has was a lawyer and had a lot of prestige, and they're bringing something beyond just the dollar amount to the partnership that isn't represented once again on the books, on the calculation, but is a value that is recognized by both the entering partner and the new and the partners currently in there, then the bonus could go the other way around.